last class, we had started off with quantitative measures. We have discussed the first four measures taken up by the Reserve Bank of India. Moving on, the fifth point, a very important one, regulation of consumer credit. What does consumer credit mean? It refers to personal debt taken by the consumer to purchase goods and services. So, consumer credit in simple is a credit taken by the consumers in order to what? Purchase the goods and services that they require. For this purpose, the RBI has two devices: maximum down payment and maximum period of repayment. Maximum down payment. When there is inflation and scarcity of goods, the RBI raises the minimum down payment and reduces the number of installments. This results in contradiction of demand for goods. On the opposite, maximum period of down payment. During depression, the RBI encourages credit to consumers. The amount of down payment is reduced and the number of installments are increased. This encourages consumers to purchase more goods. Now, the basic difference between these two conditions here, maximum down payment and maximum period of installment and down payment, is we are talking about first cases when there is scarcity of goods. We understood last class what is inflation, correct? I just gave you a gist of what is inflation. When the prices of goods and services or commodities rise, okay, and equally there is scarcity, right? There's scarcity of goods. So therefore, what does RBI do? It raises the minimum down payment and reduces number of installment. So whatever you're going to purchase, you're going to make the down payment, correct? As a token advance possibly. At that period, the down payment is going to be high. Because there is less goods available, if you want to purchase the goods at the first, you need to make the down payment in the first place to make sure the goods belong to you or the services belong to you, correct? So RBI says or maximizes the down payment in this first case. Therefore, the scarcity of the goods can be managed. So, and it reduces the number of installments. Let's say the price of a particular commodity is rupees 10,000. And since in this condition of scarcity of goods, the RBI has increased the or maximized the down payment. Therefore, out of that 10,000 rupees, the company is asking you if you want to purchase the goods, because there is less supply and more demand. If you want to purchase the good, at least you need to pay rupees 4,000 as down payment. That is exactly 40% of the entire price of the commodity. But then RBI has raised the down payment. Therefore, you have to pay rupees 4,000 in order to secure the product or commodity. And opposite, what does it happen? Reduce the number of installment. So the rest 6,000, maybe it can be paid in just 3 months, 2,000 each month. It's going to reduce the number of installments there. The second case is, it's just a mistake over there. Please note, maximum period of installment. It is not down payment, maximum period of installment. So during depression or deflation, the RBI encourages credit to customers. The amount of down payment is reduced and the number of installments are increased. So this encourages consumers to purchase more goods. Let's take the same example. The commodity of the good, the price of the commodity is rupees 10,000, but you do not have enough money. Depression or deflation means what? You do not have enough money to purchase the goods and commodities. Goods are there, commodities are enough in the market, but I as a consumer do not have enough money to purchase those goods. So what does the RBI do here? It is going to maximize the period of installment. Therefore, if the price is 10,000, the RBI gives instructions so that consumer just pays rupees 1,000 for now. Okay, 1,000 for now, and therefore the period of installment is not just going to be 3 months. Maybe it can be spread across 9 months or one complete year. You got my point? In the first case, down payment was high and the installment was low. In the second scenario, the down payment is low and the RBI is increasing the number of installments, because consumers, just because there is less money, we cannot survive without purchase of goods and services, correct? So therefore we are going to pay a lesser price and promise to pay the remaining amount in the upcoming installments. Is that clear? See, these are the two steps taken up by the RBI in order to regulate the consumer credit. So in short, you can remember, under inflation, the down payment is high, installment is low. Under deflation or depression, the down payment is low and the installment is high. Is that clear? Now I'm going to explain to you more than in detail of what is inflation, the causes, deflation, what are the causes and the measures taken up. Okay, so we're going to study about this topic in detail now. First, let's look at the meaning. Inflation is the rate at which prices of goods and services increase. That's the shortest meaning that you can remember. Inflation means inflated prices of what? Goods and services. What does it affect? The buying capacity of consumers. Now, when the prices are too high, you cannot afford to purchase certain goods and services. That is what it says, affects the buying capacity of consumers. Mostly, central banks try to limit the inflation in order to keep their respective economies functioning efficiently. If there are enough amount of people to purchase, or the money to purchase the goods and commodities, then only the country is going to develop, correct? Now that if there is prices have risen and there's nobody to purchase, or people are not able to afford commodities, there's no point of even producing them, correct? So what does RBI do is it tries to limit the inflation. Now let's look at the causes. What causes inflation? There are four main causes. Number one is money supply. We read extensively about this in the second chapter, commercial banks, right? How does commercial bank, what is the function? How does it turn the savings into investment? How does it turn the deposits into loan? How does it make the credit available to consumers in terms of individuals, in terms of companies or entrepreneurs? So that is called money supply. When there is excess of money supply in an economy, it is one of the primary cause of inflation. Got that point? That's the first cause. Now, as I told, why does the SLR and CRR rate keep on increasing according to the economic conditions by RBI? This is the cause. If RBI wants to control the money supply, what does it do? Increase the interest rate on loan. Automatically, people will stop taking up loan, or they might even postpone taking the loan. That way, the money supply will remain with the banks and not in the economy. Got it? On the opposite, it can decrease to increase the money supply. The second cause is national debt, which includes nations borrowing and spending, which is called as commonly called as fiscal policy, the spending and borrowing of government of India. In this situation, country is left with two options. So in case that's why the government has started the Make in India concept, to make sure India is a manufacturing hub, correct? Because we have plenty of labor, plenty of manpower. If we start manufacturing goods and commodities in our country, the labor cost would come down. Once the cost of manufacturing a product is coming low, we can automatically have a higher profit margin. Got it? So that is the concept behind the Make in India, to make India a production hub. That way we can start exporting more rather than we depending upon the imported goods, right? From mobile phones to perfumes to electronic gadgets, etc. We would stop depending on the imported goods, right? Whenever we are importing more, that means India has to pay. If India is buying electronic good from Japan, we are supposed to pay them back in what terms? In their country's currency, that is rupee, that is N. N is Japan's currency. Or if you are importing from US, it's going to be dollars. So we're going to pay a higher amount of money. That is when the nation's borrowing is going to be increasing. The spending is increasing over there. That is called as national debt. That's why we focus on exporting more and importing less. When can we export more? When we have manufacturing, goods and services facility available right in our home country. In this situation, when there's a national debt, what does the government do? Two options. One, taxes can be raised internally. Now, we always complain that tax rates on every budget that is announced, it has been increased. This is one of the reasons. Why are they increasing taxes? To manage their national debt. The second option they have is additional money can be printed to pay off the debt. That is mostly not followed, but only in case of emergency situation that we really can't pay off the debt, then they start printing new currency notes. That's the last option to pay off national debt. The third and the fourth are very important causes for inflation. Third one is demand pull. It occurs when there is an increase in aggregate demand categorized by four sections of macroeconomy, that is the household, business, government and the foreign buyers. Demand pull occurs when increase in aggregate demand. There's so much of demand for the goods that the prices start rising up. On the opposite, fourth, cost pushes when the aggregate supply of goods and services decreases. Remember this, demand pull is what? The demand for goods and commodities are increasing. Cost pushes, the supply of goods and services decreases. Because why? There is increase in production cost, it results in cost push inflation. So why there is increase in production cost? Maybe the labor cost has increased, correct? Or maybe there's all the other competitors have been moved on towards advancement of technology, but our specific industry is not able to cope up with the advanced technological machine and equipment, etc. So we are not able to cope up with the competition and automatically we're not able to produce enough goods. Therefore, the supply of goods and services decreases. Is that clear? Demand pull and cost push. So these are the four different causes for inflation. Now, how do we measure inflation rate? In India, the Ministry of Statistics and Program Implementation measures inflation. The most well-known indicator of inflation is the Consumer Price Index. Remember the CPI. It stands in short, Consumer Price Index, which measures the percentage change in the price of the basket of goods and services consumed by households. Is that clear? How do we measure inflation? Who measures it? Ministry of Statistics and Program Implementation. Based on what? What is the indicator of inflation? CPI, Consumer Price Index. It is measured by two indices. CPI is what? Difference in the price of commodities and services such as food, medical, education, electronic, which consumers buy for use. So on an average Indian, okay, we cannot calculate because there are people on high net worth individuals, there are people who are poor, there are middle class people, etc. So to calculate inflation or consumer price index, we take the average. Okay, we cannot calculate inflation separately for people who earn more, earn less or earn medium. So we are going to categorize as average, right? On an average, how much food, medical, education, all this combined together, what people consume is called as Consumer Price Index. On the other hand, we have Wholesale Price Index. What is it? It is the goods or services sold by the businesses to smaller business for selling further is captured by WPI. So CPI focuses on consumption, WPI focuses on manufacturing of goods and services. So these are the two measures that is indicators of inflation. Hope you have understood the concept of inflation. Moving on to deflation. What is deflation? It's the opposite. Occurs when too many goods are available. Remember, inflation is what? there is scarcity of goods. Under deflation, what happens? There is too many goods available, or when there is not enough money circulating to purchase those goods. This is exactly what we are going through in our economy right now. As a result, the price of goods and services drops. If you have seen in the banks also, right from what we have observed through the lockdown from maybe March end or April and so on, the interest rate of certain loans have come down, or the rent of homes or come down, or the sale price of a building or a land has come down. Did you observe that? That is called as deflation. There's so much amount of supply, but then we do not have enough money to purchase those goods. What is the result of that? The price of such goods and services drop. Have you observed around you? So deflation is normally linked with significant unemployment and low productivity levels of goods and services. Is that clear? Can we see this in our situation today? Can we look at unemployment around us? There were so many layoffs and there is low productivity levels of goods and services. Let's look at an example. If a particular type of car becomes highly popular, other manufacturers start to make a similar vehicle to compete. Now, this is very common, right? If one product in a particular market, it can regard to any industry. Here, the example is about automobile. Now, it can be any other electronic gadgets or any other product. Once that product is a good hit in the market, right, it becomes very popular. There will be very soon immediate duplicates, or other manufacturers start manufacturing the same kind of good. The only reason because it is popular, it is demand in nature. Soon, the car companies have more of that vehicle style than they can sell. So, they must drop the prices to sell the cars. Now, there are same kind of car or same kind of product that is manufactured by so many companies that they are difficult to sell. Yes or no? If your company's products or goods are unique and different, you can attract the customers easily. But your products are same and similar as that of the other companies or other manufacturers, would it be easy to sell? No, it would be difficult. So in order to make sure, since you're manufactured, you have to make the sales. How can you do that? You have to reduce the price or drop the price of the cars to sell them. So companies that find themselves stuck with too much inventory must cut cost, which often leads to layoff. That is what we are observing here. So they have incurred so much investment, but we are not able to make the sales. So what do? They cut down the cost. By how? By layoffs. Is that clear? Hope you have understood the example of deflation. What are the causes? Structural changes in capital market. That is when different companies selling similar goods and services compete. There is tendency to lower prices to have an edge over the competition. Now, everybody is selling the same kind of product, same quality and same features. But if your company is having a high price for that, would anybody buy from your company? No, because the same feature good is available for a lower price. So, automatically your company will also start what? Dropping the prices. Second, increased productivity. So, that can cause technology. Technology is a good way of how we can increase our productivity on and also it has a negative impact. What? If one machine can do 10 people's work, will the company opt for machine or people? Of course, the company will go for cost cutting and it will always opt for a machine which can replace 10 people. Third, decrease in supply of currency. The decrease in supply of currency will decrease the prices of goods and services to make it affordable to people. Now, this is the third cause, that is the decrease in supply of currency. That means there is not enough amount of money in circulation in the economy. So, these are the three different causes for deflation: structural changes, increased productivity, and decrease in supply of currency. As a result, what do we have from deflation? reduction in business revenues and lowered wages and layoffs. This is exactly what we are facing in reality, correct? Businesses are reporting loss in their financial accounts or in their books of accounts, and there are pay cuts across industries. It's not just software industry or not just automobile. It is related to all the industries existing in our country or across the globe. There is reduction in business revenue. Yes, they are earning revenue, but at a very slow pace. And then second, lowered wages and layoffs. So we have pay cuts across the industries, across professions. We have pay cuts as people also are getting unemployed. Not just people who are just joinees or etc., but people of a very high position like a manager or a team leader are also getting laid off, because the salary that they can pay them, or they might have 4 or 5 team leaders for a particular company, they will remove 3 people or lay off 3 team leaders and just continue the company with 2 team leaders. Is that clear? These are the effects of deflation. Hope you can connect this concept with the reality happening today. So we have completed the 5th point, regulation of consumer credit. Moving on to the 6th one, publicity. RBI regulatory publishes the statement of assets and liabilities of banks for information to public. So every now and then, that is, maybe it can be quarterly, half yearly or annually, whatever decisions the RBI takes in the interest of public economy, it has to make what? Information public. The public needs to know what are the steps taken up by the RBI or the commercial bank. Public should be aware of the policies adopted by the commercial banks according to the prevailing economic conditions. So even in the RBI website, if you go, there will be a section called as announcements or decisions, recent decisions taken. So why is that mentioned? So that the public are aware of those decisions or policies taken up. The last measure, direct action. It refers to all forms of restrictions imposed upon the commercial banks in general or in particular relating to lending and investment. Now, direct action refers to RBI does not have to take any prior permission from commercial banks or does not have to take prior decision from them, right? It might take suggestions but not decisions. The final decisions are taken up by the RBI and directly it is imposed upon whom? Commercial banks. Is that clear? And all the decisions are taken with the objective or purpose of what? Development of economy, to control the money supply for what? Avoid unnecessary speculation, as we discussed in the last class. So this is the final point, direct action, that is all forms of restriction. Generally also you can impose, let's say it can be referring to the bank timings, or it can refer to the amount of deposits held, amount of loans given, or in particular where can the banks invest, where it should not invest, to what kind of people, what is the credit limit it can allow. Okay, both general restrictions and particular restrictions are both imposed by the RBI. So this completes the quantitative measures of RBI. On a whole, it completes the functions or the regulations taken up by the Reserve Bank of India.